Welcome to the last section of the chapter. Before I actually get into talking about it, I think it's important we talk about where we've been. The focal points of this chapter have been these. We talked about worksheets. Worksheets, of course, are a tool used to prepare financial statements. It shows a trial balance, an adjusted trial balance, income statement and balance sheet, and then you've got the adjustments in there. Okay, it's a lot. It's a points hog is what it is, because you're having to fill in numbers and know where they go, and if you put them in the wrong spot, ooh, it gets messy. You get down to this section and your debits do not equal your credits, but by determining net income or loss, it all shakes out. We will do another one of these start to finish. I'll give you a B set, and I'll even give you a C set. You'll see it on the practice test. So if you're feeling a little bit shaken about worksheets, don't, because you'll see them again. Okay. The other thing we talked in length about, and I saw a lot of light bulbs go off yesterday, the whole idea of closing entries or zeroing out temporary accounts. It's not that we're just kicking them to the wayside, but they basically all funnel into the capital account that rolls into the next fiscal period. We'll do more of those as well. But I even saw you get a little bit more confident with them yesterday. I did throw the net loss at you yesterday. I hope that didn't confuse you. Just remember, go back and watch any of the videos. One little thing I touched on was the I think it's 9 steps to the full accounting cycle. I think it was 9. Just remember, you're doing 3 trial balances, checking that your debits and credits equal. You're doing a trial balance, an adjusted trial balance, and then of course a post-closing trial balance. So that's where we've been. Let's talk about what's left. The last section of the chapter has you do a classified balance sheet. Now don't get worried about the word classified. You know a balance sheet is your assets equaling your liabilities plus owner's equity. You know that. You've been doing that. A classified balance sheet just itemizes things, if you will. Puts more names with things. Definitely look at your supplemental notes for this, because I've got lots of visuals that you'll want to mark up and write. So a classified balance sheet, just like a regular balance sheet, it's the same thing, you guys. It's just a more detailed look at it. Okay. Looks at a snapshot in time of what we own versus what we owe and what we're worth. And it takes and breaks down assets into 4 categories: current, long-term, PPE, and intangible. It looks at current liabilities and long-term liabilities. And then, of course, the owner's equity is just the capital. And that is a forced number like it's always been. Okay. So you see a lot of assets equal liabilities plus owner's equity. You know what that means. It's just now we're going to subcategorize everything. Make sense? So let's talk about each of the classifications point by point. Here's what just the asset section would look like. We know it's a lot longer, but they're saying, okay, assets, yeah, we've got cash and we've got land and equipment and patents and different things that we own. But let's stop and say, let's put them in a category. It's what it looks like. I want to talk about each of them more in depth. Current assets. We're either going to use them up or convert them to cash within 1 year. So very liquid assets. We're either going to turn them into cash or we're going to use them within a year. Is cash a current asset? Yeah, it's already cash. Are we going to use our supplies within a year? Yeah. If I'm selling t-shirts, do you think that inventory will get used up in a year? Yeah, probably. So current assets are things that we're going to either turn into cash or use them up in a year. Let's take a look. Cash is already. Short-term investments. Anytime I see the word short-term, it's considered current. Do you think the ARs want to get paid within a year? Yes. Do you think we're going to sell our stuff or our inventories within a year? And prepaid expenses. So like if I go prepay 6 months worth of rent, you think I'm going to use that up in a year? Yeah. So the stuff that's a year or less is considered a current asset. That's the easy one. Long-term investments. are stuff that's going to be sitting around for a while. Investments themselves in other companies in forms of stocks and bonds. Long-term investments like land or buildings, but that they're not using as part of the current operations. Let me give you an example of this in a personal life. Let's say your family owns a home in Morris, okay? But then they've bought a lake lot that they're going to go build a retirement home on. That's considered a long-term investment. Are they using that as part of your daily family life? No, but they've capitalized on cheap lake land that they'll go invest or go build the retirement home on. Maybe a business knows they're going to expand 5, 10, 15 years down the road, and they've got land purchased, but it's not being used for current business. That's considered a long-term investment. Property, plant, and equipment, more formally known as PPE. Another one that's called, sometimes you'll see it as a fixed asset, a current asset versus a fixed asset. Property, plant, and equipment that's got long, useful lives. It's going to be around a while. The key there is it's currently being used. So do you see the difference of a long-term investment that you're not using in business versus land that you are using in business? That's the tricky one. Like our bus garage right now, is that on the school property? No, but is it being used for current? Yes. So that would show up as PPE versus long-term investment. You guys understand the difference there? I hope so. Here we see the contra assets take shape. So land and building improvements, buildings themselves. No, wait a minute, I thought land was long-term. If it's being used for the livelihood of the business, it shows up under PPE. Things like machinery and equipment, but remember, any equipment is going to have that less accumulated depreciation because every year it's losing value a little bit, and that is again, a contra asset. The last one that's kind of weird, and we'll actually talk more about these in a later chapter, intangible assets. So the assets you can't touch. I could go touch the pile of money. I could go touch my equipment. I could go touch the inventory on the sales floor in the back room. Intangible assets do not have physical substance, like if you own a patent. Superior owns patents. Yeah, they could go maybe see the actual thing that there's a patent on, but the patent itself owns stuff that can't be touched. And those are called intangible assets. Here's a couple examples. Goodwill, it's such a hard one to describe. Again, they talk about it in a later chapter, so I'm surprised it shows up here, but it does. I'll come back to that one. A film library, customer lists, again, I'll come back to that one. Franchises, sports teams, brands, okay? Things you can't really touch, they're intangible. Let me give you a Goodwill example. When Superior bought out Hancock Concrete, they got a physical building. They probably got all the customer lists, okay? But is there a corporate culture in Superior? There is. And so, like, you can't grasp that culture, but it just kind of goes with the value. It increases the value of Superior Industries because you're bringing that corporate culture now to Hancock Concrete. That corporate culture can't be touched, but you could put a value on it if you had to. It's weird. It's weird to talk about intangible assets because you can't touch them. So if I go back, this is how it looks in list format. You see headings. If there's more than one in the list, you see a stopping point that says total current. So then like here, I use the left column to do all the math and I kick the total out, okay? Under intangible assets, there's only one there. So that's why I don't put intangible assets, patents, total intangible assets. I just kicked the patents number way out there. Do you see how that works? And that's not really new. If we don't really have to total anything, we're just going to kick it way out over here. So I've got the 1, 2, 3, 4 assets to equal the total assets. And it's just categorizing them. They should. I didn't like how they did that. When I teach it to you tomorrow, we're going to have a total PPE. And instead of that 29,000 being on all that same line, I'd kick it down a line. Good question. And same thing here. This should have said total long-term investments. It's just the answer key being weird. Good question though, Jenna. Okay, so do you feel like you have a pretty solid understanding of the assets? Sure. Let's move to the other half of ALLO. So we've talked about assets. Now let's talk about equals L plus OE. Owner's equity is just capital. It's always going to be just capital. That's a forced math. You'll see how that looks tomorrow when we actually do the problems. What do you think the difference of current versus long-term is? Now that you know a little bit about assets, do you think you could tell me the story about liabilities? When do you think you're going to pay those liabilities off? Current ones. Within a year. Now. How about the long-term ones? More than a year. Okay. So let's talk about them a little bit more in depth. Current liabilities, we're going to get paid off within the coming year. They're saying they're listed in order of magnitude. I don't get so worried about order. And the liquidity, we've talked about this word, but how quick can we turn it into cash, or how quick can we get that cash off our back? So how quick we can pay things off, hopefully within a year. There again, we see the heading, list item, and because there's more than one, we're going to total it. Now, if I were doing this, I'd move all of these to the left column, and I'd put the total over in the right. Again, current assets, current liabilities, think a year or less. Long-term liabilities are just anything that's going to take longer than a year to do. Long-term debt, deferred income taxes. You know, I think about if I owe, maybe I have a bill at Willie's that I'm going to pay. That's going to be a current liability versus my mortgage. I've got a 30-year mortgage. That's going to be a long-term liability versus my $100 that I say I owe at Willie's. Okay. And then finally, owner's equity is just that. We get a little bit more detailed here, but I just want you to know, if I go back to here, this is more of what you'll see in this chapter. It's just owner's capital. We know there's some things dumped into that. We know that it had a beginning balance. They get their share in net income. They see the hit of drawing to be then what that equals, and that's the forced math. That's the chapter. What do you think? Worksheets? Yes, they'll show up on the test. Closing entries? Yes, they'll show up on the test. Reversing and closing entries, I'm just going to briefly talk about them right now, just so you feel like you know the vocabulary, but you won't be tested on it. And then a classified balance sheet. A beefed up version of the balance sheet, if you will. If anything, doesn't it make more sense when it's categorized? Current versus long-term? I think so.